Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course to make it actionable, understandable, and clear. What a week. And therefore, what a show. Appreciate all the fan mail asking me to analogize the Texas A&M football program's comeback win against South Carolina into this episode. I regret to inform you, the editors have spoken. We will not have a pronounced, prolonged, ad nauseum review of the game and the connections that could be made in the personal finance space. So appreciate the encouragement to do so. Just know our journalistic integrity is maintained. However, we've got a great show. We are going to look at why we could use a good long bear market, Wall Street Journal article. We're going to touch on Bitcoin, something that the fans always are writing about. You always want me to talk about Bitcoin. I'm always a little hesitant to, but I'll do it at your request. I will let down my nets and I will talk about it. We then talk about bonds, everyone's least favorite investing. And then we talk about why we need to be wise as serpents, innocent as doves, with my beloved Capital One, who I think is one of the finest banks out there, but they got caught with their hand in the cookie jar. We're going to look at what happened at the top. Bitcoin. Now, if you've listened to this podcast faithfully, religiously, over the years it has been produced, you'll know that your beloved host does not own Bitcoin and has struggled to understand the intrinsic value of the coin. How do I value the coin? I've tried to understand it. I've been unable to, and therefore I've missed out on the tremendous, spectacular gains that the cryptocurrency has experienced. I'd also add, I've come so far as to describe Bitcoin as an insurance policy. If someone were to really push me, I could see it, an inflation hedge and a view that the U.S. dollar disappears, yada, yada. But what happened in the past month? This is price action. This is the challenge for me with this asset class, and perhaps it could be instructive for you. In the last month, Bitcoin is down 20%. Now, there have been other months where it's been probably up more than that in a month, but this is a tremendously sized asset class that is down 20%. Why is that a real challenge? And what am I reading in the news is I see all sorts of analysis on why this price is the right price and that price is the right price, and it's got a little further to fall, but not much further to fall, and still could be $1 million a coin in 2030. At the end of the day, I am unable to articulate and define intrinsic value for this security, and therefore I have to miss out, and that's what it's been for me for the past 10, 15 years, miss out on tremendous gains. And I think this is true for me and perhaps for you on any given stock or any investment where price action is what's driving your decision to invest in it. That's for many Bitcoin proponents, not all, but for many, hey, it went up 300% last year. I'm getting in. If that is your logic, just beware. That same logic will be very difficult when it's down 20% in a month. And if, who knows, it continues on this path, the best investments are the one you can stick with for 50 years. But Warren Buffett has a line that I like to repeat is, make an investment as if they turn the market off for it for a decade. It really clarifies your thinking, and it hopefully clears out your cash system in your head, your kind of short-term memory, cash, not C-A-S-H, but that short-term memory to go, okay, wait a second. Am I really doing this because I believe in the investment, or did I get caught up in price action? I think we can all get caught up in price action, and it's insidious how it can seep into our brain. So beware of getting involved in investments where it's difficult to find that intrinsic value. Next, Wall Street Journal article, Spencer Jacab, headline, why we could use a good long bear market. Boy, do I agree. Subheadline, stocks have experienced only brief downturns over the past 16 years, creating dangerous complacency. I had a very self-aware client tell me this week, this is before I saw this article, hey, it feels like I've gotten complacent in part because I forget the years they said, for the past 17 years or so, There just hadn't been anything that major. Of course, they're referring back to the 2008, 2009 stock market credit contagion where the market got cut in half. That was great self-analysis by that individual. And I sense it in myself and in others, that the longer we go without a tremendous downturn, the more hubris, the more confidence investors have, and therefore they are risk on and potentially missing out on a proper self-evaluation of their risk profile. So this article says it well. Since this 2007, 2009, and keep in mind it took 66 months for the S&P 500 to regain the previous high, nothing really that bad has happened. It really hasn't been that bad. There have been little dips, technical bear markets. The investor has always been rewarded with buy the dip, meaning, hey, when the market goes down, buy, because you always seem to get bailed out somehow. The market keeps going up. And so the time that the investor has to spend in an uncomfortable situation is pretty limited. Lane Kiffin recently did a ESPN documentary where he talked about his affinity for hot yoga because it forced him to get in uncomfortable positions and stay there. And I think his self-awareness is excellent. I think with investing, it's even harder than hot yoga. You might think you can hold that pose in that whatever super hot room while you're sweating profusely for a long time. With investing, I think most of us cannot. I think anything longer than 3, 4, 5 months, which is basically the past 16 years, that's what you've had to experience and come out of. If it's longer than that, I think a lot of very tough people will fold like cheap tents. One gale, one swift wind will knock down what they previously thought was a strong brick house, like the Three Little Pigs. Well, what are we supposed to do? Great, Robert. You're warning us here that this is the article here. Over the past 16 years, downturns have lasted less than 8 months before the old high was reached. That is quick. Well, avoid leverage. Figure out what your most conservative position is and be willing to push past it. Override your instincts. Run a scenario through the 2009 hit or through the 1970s. It's for most people, their investing history doesn't go back that far. And so it can be helpful to run it through. Hey, from 1970 to 1980 on an inflation adjusted basis, stocks were down a ton and it was over a decade. So it's not just, hey, 4 months and back, it's you're down and you're down and you keep going down. And this is because of inflation on a nominal basis. It looks flat, but you just lost value. And when I talk to people who experience a little bit of that, they still have the scar tissue and they probably have too much of an affinity for commodities. They want exposure to gold and silver and all these commodities because that was hot back then. That recency bias, that's the $5 word there. The recency bias is we're anchoring our investment theses to what happened in the core of our investing life and what happened recently. When you go back and study financial history, you realize it is probable that if you're a listener, you will experience some sort of catastrophic financial meltdown that has not been experienced before and that you will have to survive. Can you do that? I think all of us are going to have to answer that question. My gut says that right now we're probably over-anchored to risk on. There were seasons, believe it or not, at the end of the 70s, people were over-anchored to risk off. They hated stocks, couldn't touch them. This was true of all the folks who experienced the Great Depression of 1929. Now, it was 1929, you had to wait till 1954 before you got back even with stocks. So a lot of those people just said, forget it. And the pendulum swung too far the other way. You can get to your destination sometimes with a jog and not a sprint. The old tortoise and the hare. So oftentimes we don't want to become more conservative in our balance sheet setup and our investment philosophy, because if we can make money quicker, why would we not do that? I think the pushback is, well, gosh, if you can achieve your goals in 17 years instead of 13 years, and is that 4 years really the make or break? But if you try to, accelerate your investing, you're taking risks that could zero you out or damage you. That's the stuff where slow and steady wins the race. He who gathers little by little will prosper, but wealth gained hastily will dwindle. And the Wall Street Journal article, Kristen Herr and Sam Goldfarb, headline, bonds are heading for the best year since 2020. Subheadline, Federal Reserve rate cuts overwhelm deficit fears, boosting treasuries and corporate debt. There's a great quote in this. So bonds are promises. Typically when someone thinks of a bond, they think of a U.S. Treasury bond or a Treasury note. These are promises from the U.S. federal government that they will pay back the principal and with interest as well. Companies have these as well, but they're kind of boring. And you heard this last article on a 16-year bull market. No one cares about bonds. No one wants to push bonds. The great article here, the great quote here in the article says this: "It's certainly been more fun to go to client meetings this year as a bond manager," said Cal Springer, a fixed income manager at Bagley Phelps Wealth Managers. A few years ago, I wasn't getting invited to any. Ha, ha, ha. I believe him. I find bringing up bonds is almost a fool's errand. I do it because I know I'm supposed to, and I ultimately believe that in many cases it's necessary. But this is more of a let the buyer beware. If anyone elects to own no fixed income and they're either finish their career later in life, no fixed income, all equities, you have to look in the mirror and say, I am willing to experience a decade where my value, if everything's worth $100, at the end of the decade, it's worth $75 or $80. Can I do that? Because that's what 1970 was. Why can that not happen again? So bonds, it can feel like an anchor to your investing ship. You're just slowing you down. It's the Luddite promises, and even the great Warren Buffett says he really doesn't prefer them, despite him owning $300 billion of short-term promises. I suspect there will be some regrets in the next decade with folks who, every situation's different. Speak to your advisor. It's like every pastor's sermon. It's going to be it's not homogenous. Your needs aren't homogenous. So the voice on the radio here via the podcast, it may not specifically address you, but it might. And that might means I think there will be regrets over the next decade. People will look back and say, how could I have been so foolish? I elected to own no fixed income, and now I had a 12-year bear market due to this. I don't think we'll know it. It's the Donald Rumsfeld unknown unknowns, the old Secretary of Defense. That was his warning. There are known unknowns, there are unknown unknowns. So in financial history, when people get in trouble, it's the unknown unknowns. And then in closing, Capital One, which testimonial, I use their credit cards. I think I confessed to that last week. I use the Quicksilver card because it's simple cash back. No one's impressed when you drop it down. It's a ding, 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 little plastic. I don't get the metal clang, clang. I get the ding, ding. But Capital One Quicksilver, and I use their bank accounts. I experienced what you're about to hear about. It says a U.S. judge regrets Capital One's $425 million settlement with depositors. November 7th, a federal judge rejected Capital One's $425 million settlement with depositors who said they were cheated out of high interest rates, saying the payout was too small and millions of account holders would continue to be shortchanged. A class action settlement was intended to resolve claims that Capital One froze rates at 0.3% on its high interest 360 savings accounts while quietly offering rates above 4% to new customers on similarly named 360 performance savings accounts. Ding, ding, ding. Capital One did this for sure. I was a Capital One customer who had this legacy account. And I remember logging on one time thinking, that's bizarre. It shows pretty low rate for me. And then, here's the rate online. And then as I figured it out, I had to sign up for the new accounts, cancel the old. But boy, what a violation of trust to the depositor, to the customer. And Capital One, when it first happened, said, oh, no, we don't. We clearly changed the name of the account from, get this, 360 performance savings from their 360 savings. They changed one word and they froze out the legacy people. It's a great way to violate trust. So you had your 360 savings depositors and 360 performance savings depositors. They change one word. They lock you in. And by the way, this is a bank that I think a lot of. So I hope you hear me say this. This is not a, gee whiz, Capital One's terrible. I'm still a customer of Capital One. I still like Capital One. Capital One, I think, is best in class amongst larger banks. And they did this. So what's the punchline, Robert? What am I supposed to do with this? You got to be on it. You got to be on it. You're in the world. You're in the world. And the older I get, 40-year-old that I am, I realize that self-interest is a really powerful motivator. As Charlie Munger once said, the late Charlie Munger, you show me the incentive and I'll show you the outcome. If Capital One felt they could freeze rates on legacy clients, depositors, and get away with it, they would. And they tried, and they did not. So I think they lost. Certainly, the settlement will be larger because the judge is rejecting their offer of $425. But the loss of trust, the loss of the brand loss, I just think it's just that short-term thinking. If they had called me before they did this, I'd say just take the hit that quarter. Don't try to hose your customers. It's just they have such goodwill they've built up over years. So we gotta be on it, and you don't have to check it every day. You don't overdo it. I think it can help to have an advisor look over your shoulder every time. Every time a client comes in, I've never met before, they've got this set up. In the back of my mind, I'm always a little worried, thinking, gee whiz, am I gonna find anything? Like, there's a chance these people just are playing perfect ball. And in 8 years, I found one person who I really looked up and I said, I think you're doing it. I don't think there's anything to update or optimize. And, but that's only once in 8 years. So I always am finding things because, believe it or else, almost all the time you're on the other side of the table with these financial institutions, and they know how much money you have, and they hold the cards, and they know with a couple levers they can make a ton. Capital One got their hands caught in the cookie jar. Don't let it happen to you. Focus on what you can control, which is to keep those costs low, that investing simple, and that time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.